The market has gone from please don't explore, in fact, never do that again because it's risky and you won't find anything in 2015 to here we are in 2021 and investors are piling into exploration IPOs.
It doesn't cost anything really to hold these very speculative assets and people are looking to see capital gain on them.
This is an opportunity, as you went back to the beginning, for an industry that has not always been the world's best friend. To have one of the great revaluations in a sector of a generation.
Well, hello, welcome to One-to-One Mining Investment APAC. Today, we're going to be talking about exploration finance, and I've got a fantastic panel for you today. We have Jamie Strauss, who is the CEO and founder of Digbee. We have Hedley Widdop, who is manager at Lion Selection Group, based down in Melbourne. And we have John Forward, who is Chief Investment Officer at Lowell Resources Fund, also down in Melbourne. Jamie is joining us today from London. So great to see you folks today. If we could just start things off, talking to John, if you could just give us a sort of an indication of your fund at the moment in terms of its allocation to exploration projects, early stage exploration projects. What allocation do you have to exploration, and how has that sort of changed over time? Is it more or less than before?
Hi, Leo. Yeah, look, we have always been largely focused on the pre-production sector or part of the mining sector. So at the moment we're about 70% in what we define as pre-feasibility or that's grassroots exploration for guys who don't have, or companies that don't have any resources on their books, and then guys who are still exploring but have got announced an initial resource or could be quite a substantial resource, but still very much in the exploration phase. So we're very heavily weighted towards that sector, and that's probably increased quite substantially over the last 12 to 18 months. Really, as a result of market movement, I would say that a number of these companies that we've had exposure to have grown. Either they've had exploration success, or the market has re-rated them, or both. So yeah, that's a substantial allocation in our fund at the moment.
And when you're talking to your investors in the fund, what are they saying? I want more exploration, or what are they saying at the moment?
Yeah, look, definitely. I think that the risk appetite has increased substantially. That's a theme that we're seeing across the investment universe. We're seeing appetite for risk assets. Whether it be Bitcoin, or whether it be a junior explorer in outback Kalgoorlie. And that's, in my view, largely driven by the extremely low cost of money and the loose financial conditions that we've got at the moment. So it doesn't cost anything really to hold these very speculative assets, and people are looking to see capital gain on them.
Absolutely. And Hedley, what's your experience with regard to sort of investor interest in the exploration space?
Well, I'd echo many of the comments that John's made there, and we're actually not too dissimilar in terms of a fund structure and focus to what John does at Lowell. And a lot of our investors have invested to have an exposure to the pre-mining space. At the moment, we don't hold anything which is actually at mining stage, so nothing that we're invested in has been developed to a miner at the moment. And having said that, if I was to break it down further between exploring and advanced assessments or developing, I would say the allocations within the fund have actually gone more towards the exploration. And that's not necessarily as a consequence of us having thrown more money at that. It's more a particular asset in Indonesia has gone from being ready to develop to all of a sudden it's got a hell of a lot more upside from a geological realization. So, it was 2.5 million ounces. It's headed towards 5. It could be 10 in a matter of time. So that's probably adjusted the balance of the fund. But I would say that alongside of that, the appetite in the market and the willingness of our investors to be seeing that go into exploration has been well supported. The market has gone from please don't explore, in fact, never do that again because it's risky and you won't find anything in 2015, to here we are in 2021 and investors are piling into exploration IPOs. You couldn't get an exploration IPO away in Australia, London, Canada, anywhere in 2015, but now all of a sudden you can. I forget what the proportion is, but I just looked at the number of IPOs in Australia this year, and here we sit in May. The number of mining, exploration, mining, whatever, within the sector, IPOs that have taken place is now as many as it was for the whole of 2020. So, we've actually had a huge amount of money flow towards that. And I think you see that in all markets.
And Jamie, looking at London, is this experience similar to Australia?
I think it is, Leo, but I think what's interesting is we've not gone back to the days of 2003 to 2010, where hedge funds were obviously in dominance and a lot were based in London, and where we saw a lot of the new money coming in. But it's interesting. So I think there's a greater focus still going on, which probably is still left over from to some degree the bear market, and that hasn't really kind of bubbled out yet. But I think it's probably quite interesting putting some of what John and Hedley have said into context, because the first quarter of this year, I think we raised in the exploration world $6.5 billion. That was 5.5 times greater than the first quarter of last year, notwithstanding the beginning of COVID, which was beginning to impact things last year. And where I think it's particularly interesting is then comparing that to where we were, say, in the 2010 era, where gold exploration is still, and copper exploration is still 50% below that period of time, and nickel's 75% below that time. So I don't think we're anywhere in the position of getting, shall we get nervous as to the spend. I think the spend, and I think the spend also is shifting in its focus now. What is particularly interesting is the reduction of focus in gold relative to the battery metals. So I think London is probably just another, part of the whole spectrum, of the global thing, which hasn't really changed. I think London itself has not come to the fore to quite the same extent, maybe, as Australia, which has had a bit more of a longer bull market because of the Aussie dollar, and a little bit, to some extent, with the Canadian dollar, not quite the same. And therefore, I think London's probably a little bit behind the curve and could probably catch up. But I think it's the shifting sands of the whole structure, and we got to compare ourselves as to where we were, particularly given the need of increasing output of some of these battery-related commodities over the course of the next 10 to 30 years.
Well, you've touched on an interesting point, which is sort of my next question for you, which is where is the money going? Obviously gold has been extremely important in the exploration space, but you're saying that we're seeing more money going into battery metals. John and Hedley, in Australia, where are you seeing, which metals are you seeing picking up a lot of the exploration spend?
You want to go first, John?
Sure. Thanks, Hedley. Look, I think there was on the ASX, I think there was $2 billion of that 6 billion that Jamie mentioned. 2 billion of that was raised for ASX, junior resource companies in the last quarter, and the commodities that got the lion's share of that were lithium and gold. So lithium being a battery metal has had a significant price recovery. It's not back to where it got to in sort of 2017, but it's certainly bounced a lot. So that has attracted a lot of capital. But I think and obviously the commodity prices are driving a lot of the interest in some of these stocks. But it's interesting to note, gold price is off, well, only in Australian dollar terms, off over the last 12 months by, I think, somewhere around 10%. But, there's still a lot of equity capital being raised for gold. That's probably, partly because it is easy to explore for. It's a known commodity, and it's relatively easy for a junior to develop. So yeah, they're something new in lithium and something old in terms of gold are attracting a lot of funding.
Absolutely, and I suppose it's also true that although the gold price is off somewhat in Australian dollar terms, the margin is still there, isn't it? Because we haven't really seen the costs creep up as much as they might have done in sort of 2011, 2012 kind of time.
Absolutely. I think there was a stat at the end of last year, the big 25 gold miners globally were sitting on $22 billion worth of cash. So their margins have opened up and stayed, very, very healthy. And they're, stashing away lots of cash, and that, that filters down both directly and indirectly into the exploration sector.
So Leo, can I just ask John, are you seeing the majors beginning to spend more on exploration directly, or is it going into joint ventures or whatever with the juniors? Is there a kind of tide going one way or the other on that?
Look, there's definitely, I don't have the exact stats, but the majors are definitely opening their wallets. For example, you're seeing Rio in the Patterson province in WA, around its Winu discovery, doing both actually, Jamie. They're exploring on their own behalf, but they're also doing joint ventures with juniors, and just overnight we saw Rio put money into an equity raising by, I think it was Western Copper and Gold in the Yukon at a premium. So yeah, they're definitely opening up their wallets.
I mean, that was, I was going to sort of follow up with that sort of question about what's happening with all this cash that the companies have generated over the past months or year or so. And like Jamie mentioned, I guess in the last boom, we saw a lot of the bigger companies spending a lot of that cash on M&As, some of which turned out to be, slightly ill-advised maybe, and ended up with a lot of CEOs losing their jobs. So is it possible that companies are now feeling a little bit more timid about doing those sort of big M&As and would rather grow their resource base by spending it on exploration or joint ventures with juniors rather than, spending it on M&As?
I think there's a few factors to consider there, Leo, but that's a very good point. I think the proximity to what the market realized in 2011 is still very, very close. And there's a lot of investors who remember that quite clearly. And I would say a lot of those CEOs, the ones that survived, also remember that because they would have had a number of unpleasant phone calls and meetings over periods of time where they were getting to know exactly what the market felt about how they performed over a little while. Prior to 2011, which was the most recent peak leading to a crash, I think you'd probably say that the global financial crisis crashed all markets. It crashed the mining markets as well, but the miners weren't to blame for that. If you go back to the last one before that, it was 97, 98. And people had memories about the kind of exuberance which had crept into mining at that point. But I think that was superimposed by the exuberance that crept into the tech sector and the tech bubble and bust, which occurred in between times. And it probably led to, some of the risk-taking behaviours, which peaked out in 2007/8 and then 11. And led to, it was a very, very, very long party, inflated by huge appetite out of China and the effect it had on commodity prices. And it just meant that people would keep dancing on bars and, without any kind of checking by the market, the behaviours could go to bigger and bigger numbers and bigger takeovers and strive to be bigger and bigger companies. So I think that correction in 2011 through to 15 is still fresh enough to prevent that. And it'll be interesting to see how transactions take place from here, because you also have the overlay of COVID, which I think people would glibly say that some of those transactions in 2000 and up to 11 took place without a hell of a lot of due diligence. But now if you want to do it, it's difficult to do. So you're kind of biased by the jurisdictions you can access and already have people on the ground. So I think, there's been a trend towards spend. If you were to look at cash flows of some of the bigger companies, BHP and Rio, if you put them together, or if you aggregate the whole of the Australian gold index and aggregate those as well, 2020 was a year where a hell of a lot of their operating cash flows were turned into investing cash flows. And I think in the Australian Gold Index in particular, the investing cash flows are actually larger than the operating cash flows in that year. So that's arrested a trend of saving money and putting it into investments. Now, it's not to say they were poor investments. I think that was probably led by one big deal by Newcrest and one big deal that was carried out between Northern Star and Saracen. And we're yet to see how those turn out. And they've led to tremendous growth in equity. But it's the start of a trend potentially. So, there always comes a point in a cycle where the trend goes from saving to spending, and it could be that we're very close to that point. Having seen a lot of exploration take place, there's only so much of that you can pump into the ground before you need to start buying projects or companies.
But given that we've come off a period of extended sort of underinvestment in the exploration sector, if you were to look at a sort of clock of exploration spend, if that's a thing, what time is it?
Well, we're still way down at the lower ends from the numbers that I just used. But I think also you need to look at the detail of those numbers. So mine site exploration, which is therefore the easier stuff, which requires less holes, was 40%. Sorry, I think it actually requires more holes. Sorry, the greenfield stuff requires less holes. So is 40% of the total spend. And I think grassroots exploration was actually down 19%. So last year, that's globally. So I think there was still a huge amount of caution up until the end of last year. Now, clearly the raising of exploration in the course of the last 3 or 4 months has started to show a completely different track. And I think what you'll probably start to see is, given where the focus is increasingly going, therefore reduced amount in the precious metals by the evidence of the last 3 or 4 months, and more into the base metals. And this seems to be, this is not a jurisdiction-based thing. This is a global move, obviously for obvious reasons with electric cars and all the rest of it, batteries and everything. I think you're going to see probably the need for incentivization by governments to some extent in some areas, to suddenly start increasing new exploration spending grassroots areas. Because if you don't, we're not going to be able to get the outputs to come through, which is required to support this move in battery-related commodities. So I think we need to look at the detail. Clearly, there's going to be bigger exploration financing. That's going well. Gold is still dominant in so many ways. You can actually see from the drilling numbers, gold is, way more drilling holes by gold than anything else. But it seems to be very much more mine site related rather than greenfield. So I think there's some interesting changes going on in the exploration finance world before you even bring into the argument of ESG and all the rest of it, but just related to these battery metals and the demand for that and the shift by investors. If you're looking at new people coming into the industry, going back to your earlier question, I think it is going to be driven by people looking for battery metals exposure, not so much by the historical gold dominance. That's not to say gold will fall out, but by I think that impact will shift over towards the battery metal side.
And I guess you're including copper in that mix as well.
Most definitely, probably the most important one. Yeah.
I mean, in terms of when people are talking about the energy transition and completely rewiring the world's power and transportation networks, really, for a sort of zero carbon future, and people look about how much copper is required and various other minerals. We don't have enough coming on stream, it seems, to meet the needs. How much more investment in, for example, copper exploration do you think we need compared with the amount that is going in right now?
Well, I'm sure these brilliant fund managers will have the actual numbers to hand, but my own view is it's quite scary. I mean, if you look at the amount of the grade degradation over the last 30, 40 years and the amount of output that is needed, if you were to believe, Robert Friedland or anybody with regards to the amount of copper that is needed in 30 or 40 years, there is a fundamental problem. And therefore, what's the gap in terms of exploration spend to get there? I don't think I could even stab at it, but it's huge.
I think it's there's a couple of factors that sit behind that as well, which Richard Shoddy, who from Minex, John probably knows him. He's another Melbourne-based commentator on the space, but he puts out some really wonderful global research. When he does papers on copper, he very frequently points out that I think it's every 25 years, the consumption of copper in terms of tons consumed within 25 years doubles. So, or maybe it's more than that. I think he said in 25 years, we have consumed as much copper as we had in the entire history leading up to that. And in the following 25 years, it's going to go up by another incredible amount. So not only is the consumption increasing, and surely there'll be recycling and other things, but there is this huge appetite for consumption of copper. And it doesn't matter, I don't think, whether you're talking about electrification of vehicles or battery storage. There is still a hell of a lot of copper consumed. And as Jamie just said, there's been a degradation in head grade of these projects. Exploration is one factor, but building projects is another. I mean, there are huge inventories of copper resources globally. And the reason why a lot of them are still in the ground is because they're crap resources. So, I think the industry is hedging its bets that you might find something better rather than develop something which is already known to be a heap of crap. So as time goes on, there will be discoveries, but we will eat into these lesser and lesser quality inventories, which will have to be supported by incentive prices. Now, you can look at all sorts of trends for capital spend for developing new projects in the industry. I tend to go by the free ones, and the Australian Bureau of Statistics is not a global indicator, but it's not a bad one as a proxy to say, is the industry spending money on building things or is it spending money on exploring? And since 2016, the CapEx numbers have gone more or less sideways, whereas the exploration numbers have almost, I think, trebled from the base of the cycle. And whether that's accurate and whether that mirrors a global trend or whether it's slightly different, what it tells me is that the industry is happy to put money in the ground, but it's not so happy to be building new projects, particularly in an industry like copper, if you make it specific to that example, where they do tend to need to be fairly large projects. And if they're a large project, big CapEx, you really need to see a long-term price in front of you, which is going to be sustainable for the economics which you're talking about. Now, if you're up against a barrier like that and you're a big company, you say, well, how do we increase our output? And you've got the choice of exploring or building, and or you can take something over. And I think that's probably a conundrum which quite a few of them are worrying about. And Jamie's inference before towards the investment in juniors by some of these majors is an interesting one, because I think it manages the risk for them in a completely different way to what they'd indulged themselves with in the past. They turn into a semi-liquid equity what otherwise would have been a spend in the ground, which needs to be written off of their balance sheet or sold somehow. It's much easier to deal with the junior, I suspect, than it is to sell out of exploration ground if you decided it's substandard. And what do you do with it?
Absolutely. And I mean, in terms of all these battery metals, obviously, then play into the ESG angle. A lot of money, a lot of funds, a lot of investors putting money into ESG funds. This creates a great opportunity, I guess, for the explorers who are exploring for these battery metals and copper to sort of tap in to some of this finance that's coming through. John, in terms of sort of what you're looking at, so when we're thinking about sort of exploring for battery metals and things like that, an opportunity for miners to take advantage of this trend?
Yeah, I think so. We're seeing, everybody from, the really big boys, Rio, for example, right through to, the tiddlers getting into the battery metal space and, thinking about lithium in particular, but, other battery metals as well, graphite, cobalt to a much lesser extent. Nickel is a commodity that's targeted pretty much across the board, from the juniors to the majors. So yeah, there's definitely an opportunity, and it's interesting. Juniors always think about, well, what's the exit for me? How am I going to monetize my efforts? And we've seen here in Australia with lithium in particular, the hard rock lithium space, the barriers to entry to actually making that leap from exploration to production we're not huge. We're not talking about billions of dollars worth of railways and all that sort of stuff. I think there was 5 or 6 new entrants that came into the market in production at the end of the 2010s. Now lithium price fell off, but I think that definitely encourages juniors to explore for commodities which are easy to monetize.
And in terms of ESG funds, are we starting to see people put money, ready to put money into actual, exploration projects? Given that mining, to some people, does have a slightly negative kind of score in terms of ESG, or negative reputation, I guess. Jamie,
great question.
Let me have a stab at this, because in case your viewers don't know, Digbee set up and we've got a webinar, I think, or something like a webinar at the APEC conference this week on Digbee ESG or on the education of ESG within the space. And what's fascinating from our perspective is I've spoken to probably 25 or 30 impact investors or green funds, and they're all saying the same thing. It's completely consistent. Give us a reason to buy the mining sector. That in itself is box ticked. I don't think anybody's now going to disagree with the benefits that mining can bring with regards to the products it produces, such as copper, lithium, and everything. But what a key point is, give us a credible means to track these companies. Without that, we cannot get involved in this. And what I'm finding, and it goes back to your last question as well, is I'm finding that the junior mining industry actually is bizarrely, despite the fact that these policies have all been in place with regards to Rio Tinto, BHP, and everybody for some years, and obviously some of the issues, the legacy issues of those companies are going to hang around their neck for quite a long time, where actually a lot of the juniors are now beginning to embrace ESG, not just from a battery metal point of view, but clearly that is one angle of it, but also from the fact that they know that this industry needs to fundamentally change. Well, not even necessarily change, but to prove what it is doing on the ground is good for society and ultimately can reduce emissions and have a different culture embedded within the company. Now, we're at the early days of this, but I think, or at least I can see from the people that I talk to through the business that I'm involved in on a day-to-day basis, is that there is a willingness by the juniors across the world, obviously not everywhere, but it is strengthening by the day, that they want to embrace this and they want to show not only what they're doing, but they also want to make sure that the right products are there for the industry in a transition to a low carbon economy. And I think that's quite encouraging. And I see that as the opportunity, which you were talking about earlier, as the greatest sectorial opportunity that I've seen in my life, from a revaluation from a single digit EBITDA cash flow argument, which if you take the integrated, to something much higher up as we move ourselves off the bottom of the E&S ladder alongside oil and gas, which is where Standard & Poor's have the mining industry at the bottom of the ladder, up somewhere into the middle, which is highly possible. We've got to help ourselves internally, and we've also got to make sure that we change things on the ground and therefore win hearts and minds. I think it's the greatest opportunity from a valuation point of view, let alone nature, environment, biodiversity, social, etc.
And in terms of the sort of priorities that exploration companies should be focusing on in order to, meet those ESG, goalposts, whatever the word would be, targets, what should they be prioritizing?
If you're asking me, Leo, look, I think ESG is actually common sense. It's not particularly complicated. The world has made disclosure of ESG very complicated because so many different standards, nobody knows which one to apply to. So I don't think now's the time to necessarily focus on any individual one, but I think there is about 30 topics within ESG, and we need to address all of them where it's relevant to that either project or company. And therefore what management need is an easy, and I don't want to sound salesy here with regards to Digbee ESG, but it was built specifically to address the management's ability to what do I disclose to whom and when, and the fund manager's point of view is, okay, I want something on a standardized basis with which I can compare and contrast one company to another. But the first thing is to allow management to focus on their main business and get the ESG side of it done relatively simply and relatively easy in a standardized form. And if you can give them that, then I think we're going to move this industry forward very quickly, and start to move up that ranking of E&S, so to speak.
Absolutely. So moving on a little bit, in terms of some, I'd like to talk about some sort of regions which are attracting attention right now for exploration. Headley, if we could start with you. In terms of, any regions that you find particularly exciting at the moment, what are your thoughts on that?
Well, I think it's an interesting discussion, because risk is something which the market judges one way or another as time goes on. And jurisdiction is a huge part of that risk. I mean, if the market is happy to explore, it's then a case of where is it happy to explore. And if we contrast the boom that we're in with what happened in the noughties from the late 90s through to 2007 and even 2011, I mean, there was periods of time then where if you're in a country that started with M, that was incredibly hot. Mozambique and Mongolia were terrific places to be exploring, and they had fabulous geology. They still do, incidentally. It's just that it's become a lot harder to raise money to put it into those countries. So that was a cycle where jurisdictional risk fell away as time went on, and investors were attracted to spectacularly good geology. What we've seen in this cycle, I think, is far more jurisdictionally biased. And, there has been a huge, well, I'd say even premium paid for the ability to explore in places like Australia or Nevada or Canada. And lots of the money which has been raised has gone into those places, be it for gold or for battery metals or anything else. There's still some traditional jurisdictions that attract money. Like if you want to look for copper, then lots of people will go to Chile, etc. But I think that we've seen a real jurisdictional bias in the market. And to an extent, that's probably led by the industry as well, because the industry itself, and led by the larger miners, has gone out of its way to prove how safe a lot of the jurisdictions are that they have their head offices and main projects and things like this. So, the equity market and the retail investors that support the bottom end in particular, I think, are very strongly led by that. Having said that, I think there are some very good opportunities to be looking at projects in other places, because they're going to be discounted with that factor in mind. And there are certain places you can go to you don't even have to explore. There are undeveloped projects which probably could be, and some of them are in jurisdictions which are a lot cheaper to operate in from a power and labour point of view than places like Western Australia or parts of Canada. But saying that, you need to be able to navigate whatever the minefield is of that jurisdiction that you're in. I've seen some wonderful projects. We've got some in Indonesia where you need to have really trusted and first-class partners in order to be able to make those businesses work, because it's just very difficult to navigate the local bureaucracies and avoid the pitfalls that investors can sometimes fall into there. Mongolia is another one. One of the great untouched frontiers of undiscovered large deposits. There will be more Oyu Tolgois, I am absolutely certain, and there's some very, very attractive and large high-grade epithermals which are lurking there as well for gold, but hasn't been explored for one reason or another. And I think over the next 20 years or so, the industry will swing its gaze back towards those, but it'll be the industry that leads that, not the investment market.
And in terms of selecting a jurisdiction in which to operate, this sort of ties back in with the ESG question to a certain extent, because are some jurisdictions, shall I say, easier, or some regions or some geographies makes it easier to be ESG compliant than others in terms of reporting, and maybe just the geography or the weather or something like that, which makes a project easier to do in an environmentally sensitive and community sensitive way?
Yeah, well, and this varies with time, right? Jamie, I'm sure will have a detailed view on this with his funds background there. But for example, and I don't mean this to be a callous example, but it'd be very difficult to permit a tailings dam in Brazil at the moment. So, finding a project in Brazil that needs a big tailings dam, it's going to have a blockage. And that's an ESG issue. It comes under environment, social, and I suppose there's probably a governance one there as well by the time you look at permits. Similarly, I mean, there's some very, very, I suppose you'd call them first world, not in my backyard type jurisdictions. And I suspect a lot of Victoria that both John and I live in Australia is covered by a please don't put one of those in our backyard. Having said that, very prospective geology. So I think some of those things wax and wane in time, and some of them are more fixed. But through an ESG prism, some of those places you've also got to consider the G, which is governance, which comes down to how do you conduct yourself coming from an Australian or Canadian or European jurisdiction, which have very strong laws and transparency initiatives around how money is invested and dispersed, compared to some of the places that people might want to go and be attracted to the geology, which have whether it's cultural or whether it's just opportunity, there are issues where people will stick their hand out and ask for some form of backhanded payment or gratuity in order to make something happen. And that's the kind of thing you want to avoid, but sooner or later it comes up in some of these places, and it's then a temptation to deal with it in a way which is seen as transparent. And I'd say that morals probably shift in time as well. People are capable of doing something on one occasion, only to discover later that they've changed their view, or perhaps society has changed its view as well. We've seen plenty of examples of uproar over something which I'm certain are wrong, but 20 years ago might not have seemed that way.
Absolutely. And I guess there's also the issue of countries with sort of moving goalposts, shall we say. So a country which 1 year maybe sort of democracy with great geology, and then the next year it's got great geology still, but it's run by a military dictatorship.
Well, I got a few,
or even a Labour Party.
but maybe I don't know if John wants to comment. Rather than me kind of jumping in on anything to do with ESG or so, but I'm happy to comment after John.
Look, thanks, Jamie. Just mention, in the exploration sense, I think, ESG for exploration companies is both a hindrance and a help. I think, the time frame to permit a project to go and drill on it. This is like a greenfields project that's been pegged from scratch, has obviously lengthened, and that's put a premium on drill-ready projects, which are permitted, access in place, and the environmental hoops jump through. But I think going through that process and the longer time that process is taking up front is definitely a help down the track. If there, in the case when there is a discovery. It means that the community and local people is generally more educated about what mining could involve. And in most cases, you'd hope that a more knowledgeable group of stakeholders is a more friendly group of stakeholders towards a particular project. So I think there's real pluses and minuses, but on the whole, the ESG movement is definitely beneficial for explorers.
Are you going to see, explorers maybe sort of prioritizing projects and metals and geologies which are possibly easier to exploit in an environmentally friendly way? For example, something that is coming up a lot in terms of renewables and the move towards e-vehicles and things is rare earths, particularly those rare earths which are used for magnets. And some of them, some projects maybe require a lot of treatment of the products that come out. They maybe have some radioactivity associated with them, and whereas another style of project might be sort of like a clay deposit or something where it's much easier to do environmentally. In an environmental sense. So are we going to see companies really prioritizing
Leo,
to achieve projects?
I think at the end of the day, companies and management go to where the best geology is generally, because it's difficult enough as it is, and they need to make a discovery to make a business work. So I think that is the first dominant thing. And I think ESG by and large is driven by the listing of the company, not by the underlying jurisdiction of the owner. That's not to say exclusively, but it's dominated. If you're going to raise money from institutional funds, you're going to need to include ESG. It's not going to be driven as a result of the government of country XYZ. But I think it comes back also to what Hedley was saying at the beginning with regards to risk. all of this relates to risk. And if we're going to bring people into this industry, we need probably better risk mitigation. And ESG is a form of risk mitigation to some degree. And it can be valued to some degree now. So much so that, you know, we're in discussions with the big insurers to potentially use Digbee ESG as part of a means to evaluate and create capacity for risk in the insurance industry later down the track, not for the explorers, so to speak. So I think the reason I say that is because it comes back to these jurisdictions. And I did chuckle on the M's because Mexico, of course, was a great jurisdiction. And now you've got concerns about for instance, the lithium industry being nationalized. The president hasn't actually said that, but there's enough chatter going on amongst some of the governors and senators, admittedly leading up to an election this year, that is a serious concern, not just for the lithium industry, but that would have ramifications if that was to carry through for the whole of the exploration industry. So it would be interesting to see what happens there. But I think the other thing is one of the things we're seeing is we might see a focus in jurisdictions, again, which Hedy was talking about, some of the jurisdictions that were not touched on before. So places like Serbia are receiving huge amounts of money at the moment, and they've got wonderful copper deposits on previously known deposits. Bosnia-Herzegovina has got great deposits. So there's quite a lot going on in Eastern Europe, and actually, funny enough, in Finland as well. And I think there might be focus on some smaller projects which don't have these huge, enormous things, but higher value projects where ESG actually can be, from a risk point of view, can be managed much easier, has much less impact, but at the same time can have a positive impact, both on positive nature and also on local social, while reducing your E side of it on that side. So I think there might be a shift to smaller, higher quality stuff, which previously we might not have got involved in, where we can use new technologies to improve the margin, where historically might not have done that. So I think again, it comes back down to that exploration finance shift, where there's a lot of shifting sands going on. I think it's quite possibly we're going to see a shift to a new type of investment thesis in parts of the world that perhaps that have not been dominated for the last 20 years or so.
I think it's worth remembering as well, Leo, particularly from the point of view of exploration, that explorers will spend as much money as they have. They're like a teenager at a bar, right? You can't raise money to explore for coal at the moment, and consequently, there's not a hell of a lot of exploration for coal going on. And that is a direct impact, I think, of ESG concerns, which have stemmed from global environmental concerns flowing through the investment market and then not making it to the coal explorers or anyone who might have an ambition along those lines. We've talked about battery metals, and it has this green push led to an exploration rush for battery metals. Look, I don't think that the explorers for those things are actually motivated by a hell of a lot of altruism. I think what they're motivated by is making a lot of money. And when commodity prices have gone up in response to battery consumption and manufacturing trends, the commodity prices have driven money into exploration and a need to explore for it, and that's what's led to the expenditure going into the ground and consequently discoveries. So ESG can shut those things down, but I don't know if it necessarily opens the door for spend in an exploration sense. But to what Jamie was saying, I think it definitely motivates behaviours in bigger companies, and they set a template for a lot of the smaller companies as well. They often set the bar that they need to pertain to. And the bigger companies are monitored very much by institutional money, which have all sorts of gatekeepers and voting advisors behind them as well. So that I think motivation is quite strong.
One other little thing, I might just ask, what would be interesting is the spend in the USA. Because on one hand, you've got Biden basically clamping down on a lot of stuff. Admittedly, that's easy from the coal side of things. But at the other time, you've got this huge requirement for critical minerals to be produced. So I think it's going to be interesting, and where the permitting processes go forward with regards to different metals in different states as a result of these conflicting things. I think that will be fascinating from a regional point of view.
Yeah, I mean, you've got to sort of ask the question, how high would the copper price go before Pebble finally gets permitted? Will it come down to that, or is there something else? But a point I'd like to sort of ask is we touched on it a little bit earlier about how some of the COVID shutdowns have forced explorers to sort of explore in their backyard. So you've seen a lot of exploration in WA, in New South Wales, in Canada. As we come out of COVID, are you expecting to see a shift to sort of other jurisdictions? A lot of the money sort of flowing maybe out of Australia and going to more into West Africa or South America?
I would say that that will have a lot to do with how much money is available for exploration, Leo. We don't know how long it will be until this COVID thing passes and travel returns to anywhere near normal. And on the tail end of COVID, we're going to see inflationary forces, which we don't understand yet. We're going to see the curtailment of stimulus. Perhaps you'll see more stimulus. So I think there's going to be such an economic wash through that could start to impinge on equity markets and the mining sector. No fault of the mining sector, but if it takes the money away, then it will reset things from the ability to explore's point of view. But I think if all other things were equal, there's going to be a lot of companies who have been meaning to go and explore their projects and have been discounted and discounted and discounted. So it may be that exploration push comes through an M&A drive to mop up some of the lower hanging fruit from those tier 2 jurisdictions before juniors on their own start to raise money and explore. So there's a concept from me.
I think one thing that will continue and perhaps won't change post-COVID is as we mentioned, the drive for the critical minerals and sourcing them from friendly countries. I think that supply chain issue is something that will be with us for a while. So while I absolutely agree with Hedley that we will see, once the world opens up, we will see more money flowing to jurisdictions that have been harder to explore because of travel restrictions. I think there will still be that overlay of securing your supply chain from friendly jurisdictions.
And that's got to do with ESG, but it's also politicized as well these days, isn't it, John? So, there's perhaps the foothills of a global Cold War, which is influencing certain jurisdictions that you can or can't, depending which jurisdiction you're in.
Absolutely. I think one of the interesting things will be we actually saw 3% more exploration companies last year, despite COVID, obviously having a big impact on the first half of the year. So I think what will be interesting is as ESG obligations on boards go from a principles basis, largely in Canada, UK, and Australia, to a governance basis, which I think is likely over the course of the next 12 to 18 months from what we're hearing, is how much that impacts the new startups. Because these are restrictions on companies, and it's not so easy to be running a company when you're regulated, so to speak, than it was effectively based on a principles basis. So I don't know, maybe that's just a soft issue and we'll move over that because of the bull market and people will want to get into it. But I think there is greater regulatory stuff beginning to happen on this industry, which may put some people off in setting up companies which historically haven't had much barriers to entry.
But in summary, and I think we'd probably a good point to wrap this up. But in summary, there are a lot of drivers driving finance into the exploration sector at the moment. Obviously the green revolution, so to speak, and also a lot of the majors building up a lot of cash with these high commodity prices, which they can then feed back into the exploration sector. And also, as John touched on there, the need for people to secure their own supply chain. So a lot of very interesting factors there, a lot of strong drivers there, giving confidence, I guess, for the future of exploration after many years of underinvestment. Would that just about sum it up, do you think?
I think you could say that exploration has restarted aggressively and it will keep growing until it stops. But you've captured all the factors that are lending a hand to it increasing, Leo. Yep.
Fantastic.
And I would just say, Leo, that this is an opportunity, as you went back to the beginning, for an industry that has, not always been the world's best friend, to have one of the great revaluations in a sector of a generation. We need to come together for this, but I think the money is there, the willpower is there. I think the new spirit is there, and I think it's a really exciting place to be for the next 20 years.
John, the final word.
Oh, look, I'm just delighted to see, the renewed interest in the exploration sector. It was only a couple of years ago that we were saying, oh, millennials will never invest in mining. It's too dirty and old. Well, it's almost flipped on its head and become, quite an environmentally friendly and necessary activity. So, yeah, hopefully that will continue for some time to come.
Well, thank you very much, gentlemen, for all your thoughts today. Very interesting panel, and look forward to seeing you live when we can all travel again. But thank you very much for today.
Thank you very much.
Thanks, Leo. See you.
Good on you, Leo. Thank you.